The pain may be nowhere near over for silver, but that does not mean the story has failed. What we just witnessed was not a normal pullback. It was a stress test. A historic surge met a historic unwind, and the market responded exactly how fragile systems always do when positioning becomes too crowded. After last week's violent plunge, prices may stabilize temporarily, but history suggests that stability does not mean resolution. It means digestion. Silver has only experienced declines of this magnitude a handful of times over the past several decades, and every instance followed the same psychological arc. The first phase is shock. The second is disbelief. The third is time. After speculative excess is purged, markets do not immediately reward patience. They challenge it. This is where silver now sits. Not broken, but no longer euphoric. The rally that carried prices to triple digits invited capital faster than structure could absorb it, and the market responded by violently repricing risk. Michael Oliver has long argued that the most important moves happen after a breakout, not during it. Escaping a multi-decade range does not guarantee a smooth ascent. It guarantees volatility. When an asset spends half a century trapped and then finally breaks free, the adjustment process is brutal. The market must relearn how to value it. That learning phase often includes deep retracements, extended consolidations, and long stretches where confidence erodes even as the larger structure remains intact. This is why comparisons to past cycles are both useful and dangerous. Yes, previous collapses show that silver can take years to rebuild momentum. But those same cycles also show that once a secular range is left behind, prices rarely return to their former reality. They fluctuate above it. Copper did it. Lead did it. Other industrial metals broke out of generational ceilings, endured savage corrections, and then re-established themselves at entirely higher price regimes. The question is not whether silver can fall further. The real question is whether the market is willing to accept that the old range no longer defines value. What makes this episode especially revealing is that nothing fundamental disappeared. Industrial demand did not vanish. Physical supply did not suddenly surge. Monetary stress did not resolve. What changed was positioning. And positioning can reverse violently without invalidating the trend. The sell-off exposed how much of the recent move was driven by leverage and momentum rather than long-term allocation. That does not negate the breakout. It delays its confirmation. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
For half a century, in a range from $4 to 50, okay, back and forth. That's where you're going to stay, man. Meanwhile, gold had blown out the 1980 high in 2011. Silver didn't. And then it blew out the 2011 high, coming up through 1920 a couple years ago. And boom, boom, massive gains. You can even look at a chart of copper. Don't laugh. It stayed in a range from the 70s, 80s, 90s to about late 2005. Copper was selling for 50 cents a pound to $1.50, 50 cents a pound to $1.50, like silver was for 50 years in a $4 to 50 range. Okay, copper was in a similar old reality. This is 2005 now. We're going back. Late 2005, copper finally broke up out of that range. Took it a couple months of struggle, but definitively you could say, okay, finally it's up out of that range. Within a couple quarters, it quadrupled in price up to $4 plus, from 50 cents to $1.50. And then, there were sell-offs after that, but it didn't come back to 50 cents or $1. It had a range of, average price probably $3.50 or $4. Like 4 times the height of the prior 50 year. Lead did the same thing in 2007. How come silver is supposed to stay in its half-century range when nothing else has? Okay, so it finally broke out. And if we look at the copper and the lead charts back in 2005 or lead 2007, when it broke out, within several quarters, you quadrupled the price. And it wasn't like a broad base metal explosion. It was copper, and then a year and a half later, it was lead. And then when you look at gold, repeated massive new highs. And silver is contained. Well, there's some explanations as to why that mistake has occurred. But when markets make pricing mistakes, they get into a range, let's say excessively too high for too long, like a stock market bubble, for example. When they go down, they often go way more than to correct for that. If they should drop 50, they go 80% down, like NASDAQ did in 2002. Why should silver stay confined in the $50 range? Well, it broke out, and here's two simple methods of determining, well, where might you go? If you look at an arithmetic chart, which is what people punch up on their screen, dollar on the side, dollars on the side, but not logarithmic or ratio scale. You see this $4 to 50, $4 to 50. You broke out, but when you measure the thickness of that perfect rectangle and do the orthodox technical analysis thing, you got a range, call it $45, $5 to 50. We call it 0 to 50 if you want. Add 45 or $50 to $50, and that's your swing objective, the thickness of the prior range. Well, you'll remember back a few weeks ago, we had a struggle going on for a week or so in the low to mid 90s. In other words, there were a lot of sellers there saying, hey, we've met the arithmetic swing objective. I'm getting out. Okay. And then all of a sudden, boom, you got 121. So it's evident now, okay, getting to 121 means the old arithmetic ratio or arithmetic swing objective was invalid. Okay. But when you put silver on a logarithmic scale chart, a ratio, and you measure the dimension of that 50 half-century range, from the bottom of that range to the top of that range was a 10-fold gain. If you bought silver for $4 or $5 and it went to 50, $4 or $5 went to 50. Wow, 10-fold gain, back and forth. Okay, now look at the mama market, gold. During that same time, it had 8-fold gains, but they exceeded prior gains. They didn't stay capped. So if you look at each of the bull markets, like the peak in 1980, the peak in 2011, they were 8-fold multiples. And right now, gold, by the way, gold's recent high is only a 5-fold multiple from the bear low. So it hasn't even matched those yet. But in the case of silver, if we do the ratio scale and do the same, well, what's the thickness of the range? Add it to it. It says $500. Don't laugh. Maybe it's been restrained too long. Maybe it's way too cheap in relation to gold. That's a measurable fact. Maybe it's way too cheap in relation to its own reality. It's way too cheap in relation to the degradation of the money unit. Look at an M2 chart. Look at its growth decade by decade. If silver matched the 1980 high, I haven't done the math. I bet it's like $400 or $500 just to match the 1980 high. So talk about, was that the top? Even using simplistic methods, no. By going way beyond the arithmetic goal, it's saying, hey, maybe I'm going to the ratio scale goal, well up in the 300, 400, 500 range. That's what we think is about to happen, and we think this is simply a midpoint gut kick, not a top. The other issue is, what's your point of entry? If you're not a trader now, okay, forget the trader. He's in and out every week, so his reality is week to week, okay. But a guy who's an investor, our last two major buy signals for silver. Originally, back February 2016, we said gold's turning up and silver, that was the bottom for silver. Okay, fine. But since then, we gave a couple other entry points that we considered good investment grade entry points based on momentum breakouts of silver and based on its spread relationship to gold. In other words, when you plot silver month to month versus the price of gold, and you plot that chart, and what we do is we divide silver into gold, express it as a percent. So early last year, for example, silver was 1% of gold. Now it's up toward 2%. Okay, nice move. But historically, if you go back a long way and plot that chart month by month, you'll see that for 10 years, there was a ceiling on that relationship at a very low level. And we cleared that in November. And when we cleared that and silver broke out versus gold, in other words, no longer the dog. I'm going to lead now. Okay, that's what silver said. That was $50.
Yeah.
And boom. Okay, what happened since? Okay, so if your entry level was back in June of last year, where we had our first buy at $34.79, or at that $50 level, you gave back some profits, but you didn't get any close to your average entry price. So again, point of entry is very important. And it probably affects the way a lot of people are thinking about this right now. This is sharper than even we expected, but we did expect somewhere in the middle of this clock, and we set our clock as of the November close, meaning when that spread relationship of silver versus gold breaks out, such a clear structure, you'll get a gusher. And whenever that's happened before, usually it lasts a couple quarters, where silver has had its breakout. It says, whoosh, I'm going to regain some reality versus gold. We're only starting month 3 of what is likely to be a couple quarter explosion. And again, harken back to the copper move and the lead move I mentioned. When they broke through their old reality, a couple quarters later, quadrupled, So that's where I think we are. It's just, yes, it's scary. All we're looking for now is stabilization and some sign that we're coming up out of here, not going back to the highs. That'll be a late issue. But somewhere in between here and there, we're going to come up with some numbers that says, oh.
What made the recent collapse so unsettling wasn't the size of the move, but the speed at which confidence evaporated. Markets that spend decades constrained don't transition smoothly into a new regime. They lurch, misfire, and violently reprice expectations along the way. The sudden reversal exposed how crowded positioning had become once priced milestones were reached, and how quickly leverage turns from fuel into friction. That kind of move does not signal exhaustion by default. It signals a structural transition where old assumptions are being stress tested in real time. Michael Oliver has argued that when an asset exits a generational containment zone, traditional pullback logic becomes unreliable. In those moments, sharp declines often function as resets rather than conclusions, clearing speculative excess while preserving the broader trajectory. What follows is not immediate continuation, but recalibration, a period where the market searches for acceptance at levels that previously seemed impossible. That acceptance phase is critical because it determines whether the breakout was cosmetic or transformative. What comes next hinges less on sentiment and more on behavior. If price holds well above former ceilings despite volatility, it confirms that a new valuation framework is forming. Supply responses lag, investment flows adjust unevenly, and related markets take time to realign. This is how extended repricing cycles begin, not with steady advances, but with instability that feels disproportionate to the headlines. The question now isn't whether the recent high marked an ending, but whether the market has permanently abandoned the world it came from.
Well, we favor the miners over gold, and there's a level, though, that we haven't broken through yet. What we do is we measure the XAU index, which is the Philadelphia Gold and Silver Index, but it's miners, okay? It goes back to the 1980s, so you got some history on it. We plot it in its relationship to an ounce of gold. And if you do, and you go back to look at the 1980s, 1990s, 2000, until 2008, for several decades, if you divided XAU into an ounce of gold, you'd end up on average, above and below, a range of 25%. It reached up to 35% at one time, and its lows during this multi-decade period, when you plot the charts like a box, okay? We're in the 17, 18% level. You broke through that in late 2008, and you collapsed that spread, meaning the value of the miners to what they get out of the ground, okay, to 4%. Now think about that. Something that had lived in an average price versus the thing it gets out of the ground, gold or silver, it went to 4%. I mean, we don't need miners. We need gold, silver. We don't need the miners, right? Okay. That chart is screaming at you, hey, you think I'm going to go to zero? And so since 2014, you can plot a range on that same relative performance chart. Beautiful little box. And it's like from 5% up to 8 plus, 5% up to 8 plus, 5% up to 8 plus again, intra-month, last month. Right now it's back below 8%. If you get much above the top of that range, and we think this third assault on the upper end is probably the one that's going to break out. So it didn't break out last month. But you get up above the top of that little box. Again, visualize that as a chart. When you break out above that beautiful technical range, there's nothing to stop you, technically speaking, in terms of the value of the miners to the metal they get out of the ground, until you get up to 17 or 18%, which is to say, to go bump the bottom of the floor that had existed for decades. So you go from, boom, you could double the miner's value relative to gold. And I strongly suspect that's about to occur and will show itself this year. Probably the breakout I'm expecting the next month or so of that spread. And when those spreads break out, like the silver did back in the November close, look what happened to net price over the next 2 months. It went berserk. Expect the same from the miners. So you're right, And there's 4 miners coming up with silver miners coming up in the first 2 weeks of February with earnings for the biggies. That report will be based on what? Fourth quarter, right? Okay. Go back and look at a silver chart. Where was it during the last quarter of the year? So, that's what they get out of the ground, therefore their profits are, et cetera. Average $50, okay? Somewhere either side of 50. Right now, so far in the first month, our average price is, well over 100 average price now I'm talking. And if we stabilize here and then sort of work our way back up so that February and March we're back up toward 100, 120 again, then your average price for the new quarter is going to be about 100. Okay, double what it was before. So the guys who look at earnings and say, wow, this miner's making a lot of money at $50 last year. Golly, gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of $50 or so. Wow, so the earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Yeah.
So if you're looking at that as a factor, whether you should tell your clients to buy silver miners or gold miners, you don't have any excuse now not to say yes, based even on the fourth quarter earnings, much less what looks like could be evolving for the first quarter. You get the point. There's a fundamental reason, too. They're underpriced in relation to that which they get out of the ground. And a lot of people don't like to invest in, let's say, silver futures or call options on SLV or, they just want to buy miners. It's a stock in their stock portfolio. They're haunted by certain memories that are false and also brief, like that 2008 collapse in the miners, which happened to concur with the S&P that month. But at that point in time, the miners, relative to gold, were actually breaking down on that spread relationship I talked about, where for 3-4 decades they'd been average 25%. Well, in September of 2008, they broke below the bottom of that whole multi-year performance range versus gold. This time it's just the opposite. They're cheap in relation to gold. They're cheap in relation to the stock market. They're cheap in relation to everything. And people have just been dismissing them. And yet when you look at the earnings based on, what's the average price of silver last quarter? What's the average price of silver now this quarter, or gold? How can you dismiss them? Well, finally, portfolio managers and the financial planners and so forth will have to say, yes, Mr. Jones, you're right for asking me about the miners. I kind of agree now. You can put that in your portfolio. Why? Because the earnings look great. So there may be a whole new wave of public buying. That's what I'm saying. Like especially when these next earnings reports come out for the miners in February, that start to turn heads. And if anybody does a relative study of miner value to the metals, geez, it's ridiculous. You want to buy cheap? Buy cheap.
Brazilian EWZ start to break out. Mm-hmm. And so just curious in your perspective on the dollar and emerging markets.
Yeah, dollar. We turned bearish on the dollar index in March of last year. Price then was slipping down. It got to 104.21 dollar index now. That closed that month. It then dropped fairly quickly into April, May, down into the 96, 97 area, dollar index. And what's the dollar index? It's really 70% of it is weighted by the euro primarily and then the yen. So it's an inverse of the euro and yen. Okay. Anyway, it's not the real value of the dollar, okay, in terms of buying power. That's decaying all the time. So is the yen, so is the euro. It's just that on a relative basis, one piece of paper versus another. But you broke annual momentum trend structures that if you saw the annual momentum chart, not the price chart, and go back to 2010, you see a trend line that's so clear that a kid could draw it with a crayon. And you broke that in March last year, and you dropped sharply afterwards. And then you stabilized for like almost a year now, where you're just above 100, down in the 96s, back and forth, going nowhere, but just teasing both ways, but quiet in a range, so there's no volatility really. Last month's close, Friday's close, was sufficient on price charts now, which had not broken their uptrend going back to 2010. Momentum already had back early March of last year at 104. Price closed low enough last month where if I were plotting a monthly price chart of the dollar index going back to 1980, you slip below it, finally. No noise, no headlines, just, oops, I'm below that line now. So even that line of defense, the price chart, joined with momentum. Now, we think the dollar's probably going down to challenge and maybe take out the 70 level it saw back in 15 years ago. But its correlation, by the way, the dollar index versus gold is like none. You go back, if you're investing in gold and you're based on the dollar index, what's the dollar doing, okay? In December of 2015, when gold made its low at $1,050, the dollar index was about 1 point higher than it is right now. So for 15 years, it's been above there and below that level like this. And right now we're trading about where we were in December 2015 when gold has since quintupled. Okay, so to correlate gold's moves with the dollar, not very good. Sometimes you'll get short-term coincident moves, inverse moves. But I think basically it's the big move in the dollar that will likely help, not be essential, but help gold in this process going forward. And I think the dollar slipped off that edge at last month's close. So at this point, we're fully negative on the dollar. I don't expect it to crash, but I could see a significant down move.
After a blistering 2025 rally, the shine has dulled on gold and silver as 2026 begins. The abrupt appointment of a hawkish Federal Reserve chair has already sent shockwaves through markets, halting the momentum that carried both metals to record heights last year. Gold retraced modestly by a few percent, while silver experienced a far sharper shock, wiping out a significant portion of its gains in a single session. The US dollar's rebound and climbing Treasury yields drove the initial reaction as investors braced for a Fed less likely to push aggressive rate cuts. Looking forward, the metals are entering a new phase where volatility may define opportunity. While silver may face short-term ceilings, the correction itself is not necessarily a bearish signal, but a clearing of speculative excess. Supply pressures, industrial demand, and institutional accumulation remain intact, providing a foundation for renewed upward movement once market sentiment stabilizes. Historical patterns suggest that after sharp retracements, metals often consolidate before resuming meaningful advances, potentially setting the stage for another multi-quarter rally. The key question now is timing and positioning. Investors must weigh whether this pause represents a multi-year consolidation or a brief breather before silver and gold resume their climb. If markets respond to renewed demand, both metals could reach levels that far surpass recent highs, redefining expectations for 2026. Strategic accumulation during this stabilization phase could position portfolios to capture the next wave, with silver likely leading the charge against a backdrop of ongoing global uncertainty and structural support in the metals complex. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.